Net present value is effectively the present value of future cash flows that will come from a project minus the initial cost of the project. So if the net present value was greater than zero, that means after projecting our future cash flows, discounting them back to today's dollars. If the net present value is greater than zero, that means that the present value of future cash flows is greater than the cost, and we should accept the project. Again, it's important that you understand net present value. Internal rate of return. Recall that the net present value is the present value of future cash flows that might come from a project minus the initial outlay or the cost of the project. The IRR is the discount rate that makes the net present value equal to zero. So we want a high IRR. We want a high rate of return that is going to be generated by this project. The decision rule on the IRR is if the IRR is greater than the discount rate, then the project is assumed to be profitable, and we should accept the project and invest. There are some limitations that we'll discuss in this section regarding the IRR, so pay attention. While the IRR is widely used, there are also some limitations that you'll read about here shortly. Profitability index. We should also talk about another valuation method that might be used. It's called the profitability index, and it's very related to the net present value. Recall that the net present value is the present value of future cash flows minus the cost of the project or the initial outlay. The profitability index is the present value of future cash flows divided by the initial outlay or the cost of the project. So if the profitability index is greater than 1, that means that the present value of future cash flows is greater than the cost of the project, and we should go ahead and invest. Financial securities and capital investment bonds. When companies want to raise debt financing, one of the ways they can do it is through a bond offering. With a bond offering, they will offer bond instruments to the society in return for some payments and a repayment of the bond in the future. We can see this on the timeline. With a bond, there will be a regular payment, often called a coupon, for the bond, and it will accumulate in the repayment of the bond. The bond itself will tell you what the bond payment will be, what the face value of the bond will be, which is the amount that will be repaid in the future, and it will also tell you the period of time for the bond. Many bonds are paid semi-annually, so there will be 2 payments per year. Some bonds are paid annually. It just depends on what the company decides to do, and it often depends on what is standard in the country where the bonds are being issued. We can use the concepts of time value money to discount these future payments and the future value back to the present, to determine what the price of the bond is today. We would do that using a required rate of return, such that we can determine what the value of the bond is today. A fun little tidbit about bonds is the reason that they call these payments coupon payments. It used to be that when you purchased a bond, you received a certificate, a document for that bond, that had little coupons that you would tear off and mail in to receive your payment for that period. Now, everything is done electronically, but the term coupon has remained. Stocks or ownership are equity in a firm. If a firm has 100 shares of stocks, and that's the total ownership, and you own one of those shares, that means you own 1% of the firm. Having stock or ownership enables you to have certain privileges or rights. There are 2 types of stocks that we'll talk about in this course. They are preferred stock and common stock. With preferred stock, one of the common rights is that dividends are paid annually at a specific rate. Preferred stockholders are entitled to receive these dividends, and they know the exact amount they will receive each year. If for some reason the company fails to pay the dividend, these stocks will accumulate into the future. But unlike with debt, the company won't be penalized for not paying them. Preferred stockholders often don't have the right to vote in company meetings. Instead, this is something that is common with common stockholders or common shareholders. Even if they own 1 share of 1 million shares of stock, that entitles the shareholder to vote in annual company meetings and to give their say for some of the company operations. Another important characteristic of stock is that it entitles you as an owner of the firm to have a claim upon the assets of the firm in case of a liquidation event. If the company is liquidated, then first any creditors or debt holders will be paid. After that, preferred shareholders will be paid, and last, all the remaining assets will go to the common shareholders and will be split proportionally among the owners of the firm. Capital investment. In a firm's attempt to create wealth and value for its owners, they must consider if there are any capital investments they would like to make in the future. Capital investments include projects that the firm will invest in such that they can help the company to create value. Here's one example of what a capital investment might look like. Perhaps the firm's considering investing in a new factory. They will look at the time period they will have that factory, what returns they could achieve from having that factory, and if possible in the future if there will be any sale or salvage value of the factory. The firm then can use the time value of money concept to discount those future cash flows back to the present. When it does this, it can then consider what the value of that factory or that capital investment project is today. They can consider the value of the project versus what it will cost to do the project and determine if it has a positive net present value. This implies that it is adding value to the firm, and it's a project that should be considered further to create wealth for the owners. Financial security valuation and capital investment evaluation preferred stock valuation. To value preferred stock, we use a simpler equation called the perpetuity model. The perpetuity model assumes that our dividends will go on into forever, since we, number one, are making the assumption that the company will continue to exist for the foreseeable future, and with preferred stock we already know we have a fixed dividend. We can then use this equation to come up with the value of the stock. The value of preferred stock equals that fixed dividend for an annual period divided by the required rate of return. Let's say that the dividend for a stock is $3 and a required rate of return is 10%, or 0.10. Using this equation, we can then calculate that we think the value of the preferred stock then is $30. Common stock valuation instructor. When we think about common stock valuation, we're thinking about a very difficult process. So first, let's harken back to the idea of valuing a bond. When we look at a bond, we said, okay, this is a financial instrument that has promised cash flows. Maybe that's $100 a year. And those cash flows are going to last each year for 20 years. And then there's a return of principal. In other words, when you're looking at value in a bond, it's very easy to draw a timeline. $100 each year for 20 years, plus the return of principal at the end. We discount those back to the present, and that is an estimate of the value of the bond. Well, when we talk about valuing common stock, we're using the same principle. In particular, the value of any asset is the discounted value of its future cash flows. For bonds, those were the interest payments and the return of principal. But once we talk about an equity security, in particular common stock, now we are almost at a complete loss as to what those cash flows are going to be. So the process here involves estimating the cash flows to a common stock, essentially over all eternity. Now, of course, if you wanted to start estimating and discounting cash flows for an unending series of dividends, that's going to take a long time on the exam, right? But what we're going to do is essentially develop simplifying assumptions. So the first simplifying assumption is to assume that we have a dividend at time 1 and that it's going to grow at a constant rate forever. Well, there's some fancy mathematics that we can do there that make the formula collapse into something that's easy to work with. But what we end up with is a value for this infinite set of dividends that's growing at a constant rate. Now that's not appropriate for all firms, but maybe there is a subset of firms that we can say, well, these dividends are going to grow at a constant rate forever. And that actually ends up being a pretty good model. Net present value NPV is the sum of expected discounted future cash flows of a project. NPV tells you how much value would be added to a firm by doing a particular project. Advantages of NPV are that it considers all cash flows, takes the time value of money into account, and considers the risk of the project. Disadvantages of the NPV are that it may not always consider the whole picture when it is used to compare two different sized or mutually exclusive projects, and that it is difficult to estimate the cost of capital of a project. Internal rate of return IRR is the return on the investment of a project as a percentage. IRR makes the NPV of the project equal to 0. The many advantages of the IRR include that it is easy to interpret, that it considers the time value of money and all cash flows, and that it does not first require the calculation of the cost of capital. Disadvantages of the IRR include that the IRR does not consider the amount of value created. It cannot be used when comparing mutually exclusive projects or choosing multiple projects. It cannot be used when the cash flows of a project are not conventional. The reinvestment rate of the IRR is often unrealistic, and the IRR cannot be used to compare projects with different lives. Profitability index, the PI, is the ratio of discounted benefits to discounted costs. The base advantage of PI is that it is useful for ranking multiple projects when the budget is limited. The disadvantages of PI are that it requires an estimation of the cost of capital and cannot be used to compare mutually exclusive projects. Financial securities and capital investment bonds are issued by companies to raise debt capital. Bonds pay coupons and mature after a certain amount of time. Stocks are issued by companies to raise equity capital and do not expire. They pay dividends and give owners certain ownership rights in a company, such as the right to residual claims. Common stock represents equity in a company, has variable dividends, and confers voting rights on shareholders. Preferred stock is a hybrid security that has fixed payments and does not confer voting rights on shareholders. Capital investment is a sum of money that a firm raises to invest in long-term projects to achieve its objective of maximizing shareholder wealth. Financial security valuation and capital investment evaluation. Financial securities and capital investment. Financial security valuation and capital investment evaluation time value of money functions are used to calculate the current value or price of a bond and a bond's yield to maturity. The perpetuity model is used to value preferred stock. The Gordon-Grove model, derived from the dividend discount model, is used to find the intrinsic value of common stock. The capital asset pricing model is used to determine the required return for stock. NPV, IRR, and PI can be used to evaluate whether capital investment is worth pursuing based on certain criteria. Summary: the NPV method gives you an idea of the dollar value that would be added by doing a project. However, estimation of the cost of capital is difficult and can lead to incorrect valuation of the NPV. The IRR is easy to interpret, but it cannot be used if there are multiple sign changes in cash flows or if projects are mutually exclusive. The PI is useful when you have to rank projects due to capital constraints, but it cannot be used for mutually exclusive projects. Like the NPV, the estimation of cost of capital is difficult and may lead to incorrect valuation. Bonds are known as fixed income securities because of their cash flow pattern, in which the borrower pays a fixed interest payment to the bondholders each year. Common stock represents equity in a company, has variable dividends, and confers voting rights on shareholders. Preferred stock is a hybrid equity that has fixed payments and does not confer voting rights on shareholders and whose dividends must be paid before common stock. Time value of money techniques can be used to find the YTM and price of a bond. The perpetuity model is used to value preferred stock, and the Gordon-Grove model is used to find the intrinsic value of common stock. The capital asset pricing model, CAPM, is used to determine the risk-return relationship for an asset and is a way to price risk. What indicates to a firm that a project will increase shareholder wealth? The NPV is positive. The NPV is an estimate of the dollar amount that would be added to the firm's value as a result of the investment. What part of the NPV calculation is very important but difficult to estimate? The cost of capital. The cost of capital is affected by several things, such as different capital structures, timing of cash flows, and investment potential, which makes it difficult to calculate. An inaccurate prediction of the cost of capital may cause a firm to miss out on good projects or accept bad projects. What is an advantage of using the NPV method? It calculates the dollar value that would be added to the firm by doing the project. The NPV is expressed as a dollar amount, and the result of the NPV calculation is exactly how much value would be added to the firm from that specific project. What is a disadvantage of using the NPV method? It is not an effective way to compare projects of different sizes. NPV should not be used to compare projects of different sizes. Suppose Alice is trying to explain to her friend, who knows nothing about the time value of money, why she should invest in Alice's new company. Which method of valuation should Alice use to convince her friend to invest? Internal rate of return, IRR. The IRR is easy to interpret, which makes it ideal for communicating the potential of an investment decision. Which NPV value indicates that the IRR has been reached? $0. The IRR is the rate of return that makes the NPV of a project equal to 0. Why is the IRR a poor valuation method for a project with unconventional cash flows? There are multiple sign changes in the calculation resulting in multiple IRRs, and it is impossible to tell which IRR is the correct one. Projects with unconventional cash flows must be valued using NPV. A company called Bobby's Books is considering purchasing a new bookbinding machine. The company calculates the hurdle rate of the project to be 9% and the IRR to be 11%. Should the company purchase the bookbinding machine? Yes, because the IRR exceeds the cost of capital. When the IRR of a project is greater than the hurdle rate, the required rate of return or cost of capital, it indicates that the company should accept the project. Which capital investment evaluation method is presented as a ratio? Profitability Index PI. The PI is the ratio of discounted benefits to discounted costs. How does the PI aid in interpretation of the NPV? It gives an idea of the return generated by a project. The PI scales different-sized projects so that their returns are comparable. Should a firm accept a project that has a PI of 0.8? Why? No, because the project would be generating cash inflows that are 20% short of the initial investment. As a rule, firms should accept only projects that have a PI greater than 1. You calculate the PI of a project to be 1 but realize that some aspect of your calculation was incorrect and needs to be adjusted. Which adjustment to the PI estimation should cause you to reject the project? The cost of capital was underestimated, so you adjust the cost of capital to be higher. Increasing the cost of capital decreases the PI. Therefore, the new PI will be less than 1, and you should reject the project. Why might a firm prefer to raise capital through stocks instead of bonds? Stocks do not require the firm to repay the par value to investors. Stocks are shares of ownership in a firm, so the value of the stock is not required to be returned to investors. An investor just purchased a bond for $973 that has a par value of $1,000. What type of bond is this? A discount bond when the market price is less than the par price of a bond. You know that the UITM is currently higher than the coupon rate of that particular bond, so it is being sold at a discount. In what way is preferred stock different from bonds? Companies are allowed to skip payments to preferred stockholders, but not to bondholders. If companies skipped bond payments, they would go into default. Companies can skip payments for preferred stock. However, by skipping these payments, companies are not able to pay common stockholders and must pay dividends in arrears at some point. Why might a firm seek capital investment? To purchase long-term assets for future growth, firms need funding for projects that will increase shareholder wealth in the future. Which method should you use to calculate a bond value? The PV function in Excel. You should use the PV function in Excel given the rate FE per and rate input variables. You are evaluating a common stock. What is a key assumption for this evaluation? The growth rate is assumed to stay the same forever. Common stock valuation uses the constant growth model under the assumption that the growth rate is constant forever. What is the name for the process of evaluating and planning for purchases of long-term assets? Capital budgeting. Capital budgeting is the process of evaluating and planning for purchases of long-term assets. Why is it important to have an accurate, carefully calculated required rate of return as part of the NPV? An inaccurate required rate estimate could cause a firm to reject good projects or accept bad projects. While the required rate of return is the most difficult part of the NPV calculation to estimate, it is also the most important. A company is trying to decide which of 4 projects to invest in. Project 1 has an IRR of 14% and an NPV of $54,000. Project 2 has an IRR of 11% and an NPV of $67,000. Project 3 has an IRR of 9% and an NPV of $60,000. Project 4 has an IRR of 13% and an NPV of $47,000. If the company can do only one project, which project should it choose to add the greatest value to the firm? Project 2, the project with the highest NPV, will bring the most value to the company. The company Betsy's Wigs is considering 3 potential projects that are not mutually exclusive. The IRR, NPV, and PI for each project are listed in the table below. Use this information to rank the projects in the order in which Betsy's Wigs should accept them to bring the most value to the firm. Project 3, Project 2, Project 1. The projects with the highest PIs should be accepted first. The UITM of a bond went from 8% to 7%. What can be predicted about the price of the bond? It will increase. There is an inverse relationship between the ETM and the price of a bond. A potential project to expand the size of an apartment complex will cost $100,000. Its calculated net present value is $5,000. Given this information, which statement is correct? The project should be accepted because it has a positive NPV. Because the NPV is positive, the project should be accepted.